Good afternoon, everyone. My name is Brian Overby. I'm the Senior Options Strategist with Options Play. And I'm doing a quick sound check here to make sure everybody can hear me okay. We got quite a few that have already logged in. We're going to be kicking off this event at the top of the hour, which is in 4 minutes here, which would be noon Eastern time. And the title of today's what event or webinar, I don't even know what to call them nowadays. Webinar feels old to me, but of today's event is hedging your portfolio. So we're going to go and look through how to hedge an individual stock and then different ways that you can look at hedging your entire portfolio. I'll be using a PowerPoint, and I will be using also the Options Play platform, which is available to all First Trade clients. So in this instance, if you do see the Q&A box, that's actually made available just to the hosts of the show. I'm sorry, the chat box. If you do click on the Q&A box, there will be a chance to answer questions during the show. And fortunately enough, I am not traveling at this point in time. I'm actually back in my home office, so I shouldn't have any problems trying to figure out where those questions are coming in at. So if you're hearing me okay right now, please let me know inside that chat box if the sound is out, or the Q&A box. And we might as well test it out. And as I said, we got 3 more minutes here before we kick off, but you might want to pop open that Q&A box and just check it out. All right, Dwayne and Justin, excellent. Appreciate that. All right, so get your questions ready. Now, ideally, when we're doing this presentation, we're going to probably address a lot of the questions along the way, so I might not get to your question right away. I'll try to address a lot of them at the end. The entire webinar today, I'm going to guess, is going to take about 45 minutes. The only thing is we have it's a big day in the markets in that NVIDIA is going to be announcing earnings. So I'm going to share with you some thoughts on how you might be able to protect your NVIDIA position. So I don't know how long, if we get down that road, how many questions might happen, but ideally we're done in about 45 minutes. That would be 12:45 Eastern time. Hello, everyone. Welcome to Hedging Your Portfolio. I am your presenter today. My name is Brian Overby. I am the Senior Options Strategist with Options Play, and I'm also the author of the Options Playbook, which I might be highlighting the website a little bit today for my book, to go through a little bit on how to hedge your portfolio and some of the synthetic relationships that you can see inside the options marketplace between put and call options. So quite simply, before we get too far along, I do need to say that we do have a disclaimer that we will be showing actual securities and are not meant to be recommendations. And also, past performance is not a guarantee of future results. So here is our agenda for the day. We're going to look at the rights and obligations of calls and puts, and we're going to just talk a little bit about the nuances between the two. And then I'm going to walk through a couple of XYZ examples about buying a protective put on an underlying stock on any security. And we'll talk a little bit about index options, but more than likely we're going to lean towards the ETFs today, just because of the size of the indexes versus the ETFs that track them. And then we'll look at the math to go through a portfolio protective strategy. And then we'll talk a little bit about the things to think about. So to start with, we're going to be pretty basic here. And we want to make sure that we're including everybody along the way. If you do have any questions, especially at the beginning, I'll keep an eye on the Q&A box. Now ignore the chat box. The chat box is only for the presenters today. So if you do have any questions, please do toss them in to the Q&A box. All right, here we go. So as far as option trading is concerned, we have 4 basic positions. And what's important to realize is that if you are the buyer of an option contract, you will receive a right. And we're going to focus on that right today. Now, one of the biggest things that I've always noticed about beginning option traders or people, even longer term option traders, they come with the thought that options are used to speculate on a movement in the marketplace. So if I want to use the leverage factor that's in an options contract to try to make as much as I possibly can because my forecast is going to be correct, right? And that's actually not what options were originally intended for. What they were intended for is what we're going to talk about today, protection. Options have been trading well before 1973 when the Chicago Board Option Exchange first started trading listed options. The marketplace didn't thrive because there just wasn't anybody to make sure that people made good on their obligations, and that's what the exchanges helped out with quite a bit. But with that said, that is what it was intended. The reason why options were put together were as a protective measure. And there's a lot of synergies between the options marketplace and the insurance marketplace. As a matter of fact, if you've traded options for a while, you will hear the price of an option contract referred to as a premium. Just like when you're paying your car insurance, you say, I'm paying my car insurance premium. You're not saying the car insurance price, right? You're paying the premium to buy your car insurance. And also, when you sell an option contract, if you sell an option contract, you are considered short that option contract. But a better way to say it is that you are the writer of the contract. You are acting as an underwriter if you're in the insurance world. So back in the day, you would legitly write up a contract and you would hand it to a buyer and you would shake hands, and the terms and conditions that were inside that contract would apply. And so like in our example, whenever you see a quote of an option contract in this day and age, you're really seeing a contract. You're seeing an abbreviated contract that's highlighting the main points of it, like the expiration date, the price at which the transaction would occur at, which is the strike price, and the type. Are you buying a call, which allows you to call stock away, or are you buying a put, which allows you to put stock to somebody? And if you think of it from the insurance world, call and put makes a lot more sense, right? A lot of people don't quite understand why they're called a call or called a put, And it's mainly because that's what you're going to do with that underlying. And I'm going to use stock as a better way, but the ideal word would be underlying security, because you can buy options on everything. You can buy them on futures, you can buy them on stocks, obviously, ETFs, indexes. So there's a lot of underlyings that would just be considered securities in general that you can buy options on. But if you are the seller, that means they can call it away from you. And if you are of a call, seller of a call, they can call it away. And if you're the seller of the put, that means they can put it to you. So thinking of it as the insurance company selling something is a good way to start this presentation, because that's where options originated from. So here's what we're going to focus on today. If you are the buyer of an option contract, you would be considered long that option contract. We're going to focus on buying a put. And buying that put is a right to sell the underlying stock at a predetermined price for a predetermined time. So let's focus on that. These are the 4 things we can do, but this is where we're going to hang out today. We actually might bring in the other side of the equation, the selling. We're going to talk a little bit about reinsurance on our protection strategy today. But we're going to start out by talking about what a put option is and where it comes from. All right, so this is an actual security that I took the prices of. The underlying stock, just for reference, is Walmart, but I made it a generic example because to me, I'm not saying that I would need to hedge a stock like Walmart or protect it. And every once in a while I'll throw out the word hedge. Hedge just means that you are putting on protection, that you are buying insurance, and that is one term that gets thrown around a lot in the options world but never gets defined. So if I'm hedging a position, that means that I'm protecting that position against a downward movement in the marketplace. So our underlying stock here in my generic example is XYZ. It's at 86.60. We're going to buy 100 shares. Now, most of the time, you don't buy 100 shares and then buy a put, right? You usually own the stock and then buy the put afterwards. And it's quite simple that if I'm buying 100 shares of stock and I buy it today, I don't think the market's going down, right? I'm not buying 100 shares of stock because I'm bearish on the stock. I'm going to buy, but in this example, I just want to let you know that we're doing this as of today, and these were actual prices on Walmart. I guess I put the example together based off of yesterday's closing price, but this is, to me, a very generic example with in my mind, a very generic stock. Walmart trades at about a 20% implied volatility. It's not extremely volatile, but it's not volatile at all. So we're going to buy 100 shares of the stock that we're going to call XYZ going forward. It's at 86.60. So that's $8,660 to buy that 100 shares if you bought it outright. We're going to say we bought it, and today we're going to buy a 30-day 85 strike put, which is just below the marketplace, and that's trading for $1.20 in this instance. This is just like your car insurance. You have to pay for it to get the right to get a new car if you wrap your car around a tree, right? But you have a deductible. If you usually buy car insurance, very rarely do you buy the zero deductible insurance because it's fairly costly. So are you going to buy the $500 deductible? Are you going to buy the $100 deductible? Usually you have some type of deductible when you're talking about just insurance on a product like your car. In this instance, we're going to buy the 85 strike. So our insurance policy doesn't kick in until we get down to 85. So we're at 86.60 right now. So that's $1.60 before the insurance kicks in. We have 30 days on this policy, and time is money, as Mama always said, right? If you go out further in time, it's going to cost you more. And I'm going to opine on days to expiration, what you want to consider at the things to think about section at the end of the PowerPoint here. So we're going to buy one 30-day 65 strike put. We have a small deductible from 86.60 down to 85. But if the stock then comes all the way down and say it goes to 80, we can take the stock at 80 and we can put it to somebody at 85. So this is a debit. We're paying $1.20 for it. For that right, we have to pay money. And that means that our net debit for this entire position, if we put it all on as one trade or on at basically the same instance, we're looking at $88.20, which is the price of the put plus the price of the stock. So based off of this is one contract, 100 shares. Each contract represents 100 shares. So you're looking at this whole gaggle of securities is going to be $8,820. Now, for the next 30 days, our max risk is going to be the deductible from $86.60 down to $85, which is $1.60, plus the premium paid. If you think about your insurance, right, you pay that up front. You don't, if you drive your car into a tree, the insurance agent doesn't say, oh, you were right, you are a horrible driver, here's your premium back and a new car, right? It's a cost of doing business. So that gets added into our max risk here on our protective put example. So $86.60 minus 85 is $1.60 plus the premium, or $2.80. What's nice about this scenario, it means that for the next 30 days in XYZ, fictitious company, the maximum we can lose on this stock is 3.6% on the downside. That's the maximum that we can lose. Our reward, though, is unlimited. We have unlimited upside because you know why? We own the shares. So we still own the underlying stock, and our ideal scenario would be that the stock went up 5, 6, 7, 8 points, right? Or at least $1.20. Why? Because our break even has now been increased by what we paid for the put, which is $88.20 in this instance, or the net debit paid for this trade. Now, this is a profit and loss graph of the protected put that I just snapped out of the options play platform. But you see here, underlying stock right here, this would be the 85 strike put. You own the stock, so you have unlimited upside and you have limited and known downside. You can take the stock if it goes to 80 and put it to somebody at 85. So my first question to you is, if I do this strategy, am I bullish or bearish on the underlying stock? Think about that for a second. Am I bullish or am I bearish on the underlying stock? Well, and you can put in an answer if you want to participate in my reindeer games by throwing it into the Q&A box if you want to do that. But if I look at this and I just look at the profit and loss graph, this gives me a hint, right? Ideally, I'd like to say that I'm bullish but nervous, because my best case scenario is that the stock goes up because I own the 100 shares. Now, buying this put, I was nervous about something, so I bought the put. But ideally, if I was truly bearish on the underlying stock, I should just sell it, right? So this gives me protection. My best case scenario is that the stock continues on up and goes up at least the price of what I paid for the put to offset the cost of the put on this instance. So bullish but nervous is my outlook on this underlying stock. This is a straightforward example using real prices in the marketplace. And we have, for the next 30 days, we have limited our risk to 3.6% on this trade. All right, now I want to give you another example, and this is going to feed into the portfolio example that I'm talking about. On an underlying stock like XYZ that we have here, $86.60. I don't know if I would if I would be looking at doing a put spread to reduce the cost, because the cost wasn't that much up front anyways. But more volatile underlyings like Nvidia, who's going to announce earnings at the end of the day today, or bigger underlyings like the S&P 500 index. The ETF that tracks it is the SPY, and you know that's an expensive underlying, and because of that the options are expensive. And I should kind of emphasize that too, in that if you are buying, if you have 100 shares of stock of a $86 stock, it's going to cost you less to insure the $86 stock than the $160 stock, right? So if you double the price of the stock, you're going to increase the price of your insurance. And the best way to think about that is it going to cost you more to insure a Bentley or a Ford Taurus, right? The cost of the underlying matters. So if you have a $160 stock could go from 160 all the way down to zero. In theory, right? The stock could go from 160 all the way down to zero. So that's a lot more risk than going from 86 all the way down to zero. So because of that, there's additional risk. You're going to have an additional cost to the put option. Okay. So if you get in that scenario, do you really need full insurance to go all the way down to zero, as we're talking about here, right? I have the right, if the stock was at 86.60 and went all the way down to $10, I can take the stock at $10 and I can put it to somebody at 85 in this example, right? So I have full insurance all the way down to zero on this underlying. Now, what a lot of insurance companies will do actually is if they have a lot of risk, say homeowners in Florida, and they don't want to take all the risk, unfortunately, because of the hurricanes that we just recently had and a few other hurricanes that have been striking that area. So they reinsure. They go out to another insurance company and will sometimes sell off that risk. So what I'm proposing here is if it's an expensive underlying, let's reinsure. Let's go out and sell off. We don't need insurance all the way down to zero in this case, is what our thought is. So we're going to buy that 120 strike put 30 days away, or the 85 strike put for $1.20, still 30 days away. But we're going to say, okay, I don't think the market's going to go below 82. So we're going to sell off the rest of our insurance policy, our catastrophic insurance. And we're going to sell a put for $82, which means that our protection only works from 85 to 82, but our net cost comes down by 45 cents. This is a net debit, this is a net credit. So now if we go down and look at our break even is now reduced by the amount of the premium brought in. The total cost is reduced by the amount of the premium brought in. So our break even is now 87.35. So that's a lot better break even than we had on our at 88. What was it? 87.60. 88.20. What am I talking about? 88.20. Okay. That makes more sense. So we've greatly reduced our total cost and our cost basis on our gaggle of securities. Still have unlimited upside. The market can go, you still own the stock, so you still have unlimited upside on the underlying. But the max risk is now, and this is a little bit weird way to kind of say this, and I didn't really know how to put it together on the slide, but you take where your cost basis is at, minus 85 is $2.35 versus 280 if we bought that if we bought the put outright. But we have no help. From 82 on down, we have no more help. And this is the difference in the profit and loss graph, right? We have this substantial unlimited upside. We still basically like if we own the stock, but our insurance, our reinsurance policy, selling off this risk from the downside, from here on down, we still have risk. We plateau in the middle between the strikes. So in our example, this would be between 85 and 82. We didn't pay as much for it, and we have substantial upside potential on this. And this is, to me, the protective put spread is a very interesting alternative on an expensive underlying. And I'm going to actually work through an NVIDIA trade today just because it was very serendipitous that they're announcing earnings. I'm not saying I'm bearish on NVIDIA. Well, I guess I could say I think that the forecast would work, that if I had a outlook on NVIDIA, I'm bullish but nervous, right? The stock has made a strong run up over the last month, and earnings, you never know what could happen. It might be an opportunity to sell off. So we're going to look at that example before we get too far along. All right. Ah, 8720. Hey, thank you, Anonymous. I appreciate that. That's so that math did work out, didn't it? Okay, so if I if I if I look at uh, if I'm looking at just these strategies that I introduced in the PowerPoints, what are things to think about on a simple basis? And this is going to apply to a portfolio, which we're going to look at here shortly, and it's also going to apply to an individual stock. If I buy that put on XYZ and the market goes down, do I have to exercise my put and sell it at that strike price? And the answer is no. And most of the time, I don't think you're going to, right? If you bought the put as protection, you're like I said, you're bullish but nervous. So depending on exactly why the market went down, obviously, uh, most of the time people would buy the put and then at some point in time sell the put to try to capture any gains that you might have to offset some of the loss on the underlying stock. Now, the downside is that it's not going to be one for one. And if you think about it with your car insurance, you usually, in most cases, you don't come out ahead when you have an accident. You don't usually end up with a brand new car. There are some other, insurance companies that will try to market that. But ideally, you still pay for the premium. You still have a deductible. You don't always come out ahead by having an accident in your car. And say you total your car and they got to give you a new car. In the options trading world, that is also true. So if the market comes down, you're going to have some profit on your put, but it's not going to offset one to one because we're actually starting out of the money. We're adding some deductible on our put option in most cases. Are you bearish on the stock? The answer is no. I'm really bullish. If I'm truly bearish on the stock, I want to sell the stock. Then just sell the stock and get out. If I'm buying this, I'm buying the protection. And that's the reason why I'm doing it. I'm doing it because something is happening over, in our example, the next 30 days. Do you need catastrophic insurance on the downside? The answer is sometimes no, and it's really about the cost up front. So our initial example, we bought a put outright. That was catastrophic insurance. That insured the stock all the way down to zero. We could take the stock and put it to somebody at 85. Is constant put by the catastrophic insurance. So what's the alternative to that? I lost my train of thought for a second. So what's the alternative? Is to do the put spread, to reinsure the position. You buy the put and sell off the risk that you're not as worried about. You're worried about a small move to the downside, not about a big move to the downside. And there are times where that makes more sense. NVIDIA is going to be one, and we're going to look at that. Is constant put buying cost effective? Well, this is another issue that if I'm doing this, a lot of people will say, well, I could lower my risk to 3.6%, I think is what we came up with on our slides. So is every 30 days am I going to buy another put? And the answer is no. If you're buying continuous put options, then you got to really think about what's your outlook for the underlying stock. I'm going to do it every once in a while. I'm going to do it when I'm nervous about something or something's going on. I don't necessarily need to go out and buy a put because of if I do it over and over and over again, I should really just sell the stock, right? Because I'm truly bearish and I'm not really bullish on that underlying stock. So I'm going to do it for a specific event. So you're talking about a portfolio insurance. We saw the S&P 500 index, and i.e. the VIX, jump up prior to the election, right? Everybody was nervous about the election and it just needed to go away, in my opinion. So to use a real life example, S&P 500 index puts, which are used quite often by institutions to protect their portfolios, increased in price because people were buying them just because of the unknown event. They were worried about that event. And so you saw that the demand for those increase actually the VIX, the VIX index, the volatility index. And that's just a simple way to look at it. But that happened because a lot of people were buying it around that known event. And then after the event, we saw the cost of those put options go down and the implied volatility showed that respectively. We saw that inside the index of the VIX. Okay, so and what expiration should I buy? Well, I want to get through the known event. In my example, I looked at a 30-day expiration just to keep things very straightforward. But I probably don't want to buy a 30-day option contract. On an expensive underlying, it's going to be expensive. You're going to pay. Time is money. So I really want to use as short a term option as I possibly can, but also know that I don't want to be so short, especially if I'm buying a put outright, that time decay is going to kill me. So I don't mind picking something kind of medium. If I'm worried about the next 2 weeks about an event, maybe I go out and I buy a 21-day or maybe a 30-day option contract because I can just sell it outright. A little bit different if I'm doing the put spread because I'm buying one and selling one. And so I have an option contract that wants the market to go down, but I also have an option contract that I'm sold that wants the market to stay the same or go up. So I'm going to be a little bit more picky on my expirations when I am doing the long put spread as a protection. So for example, if I was worried about the next 14 days, well, I might just do a 14-day put spread, mainly because I want it to reward me with the maximum that it can. And in order to do that, I need the short put to have some time decay and wither away. So it's a little bit riskier when you're doing that because, you know, what if you get the timing wrong? But just keep that in mind. So here's the issue about going all the way back to constant buying of puts. And this ties in to this consideration, should I roll up? These two kind of go hand in hand because here's an issue. If I am constantly buying puts, what strike price am I going to be buying? So let's say the stock is at 86. We buy the 85 strike. 30 days go by and now the stock is at 90. Do we buy the 85 strike again? No, maybe we buy the 88 strike. And then let's say the stock now, before we know it, goes to 85. So then do I sell the 88 strike and roll up to the 92 strike? Now we're getting into a lot of costs because in the options world, first of all, the markets aren't as efficient as stocks. So you're paying real bid-ask spreads every time you do it. And in most cases, except for at first trade, right, you have commissions that you could be buying. So in that instance, should I roll up? It's a tough question. And this goes all the way back to what expiration do I want to buy? Do you want to roll these up? If you go out 60 days instead of 30 days, all of a sudden the stock could do what you want it to do and go up. And all of a sudden your put be way out of the money and not really be protecting you very much. So my answer is I don't really want to roll up. I don't want to go so far out that I got to roll up my position. So I want to think a lot about my expiration. And bottom line is, if I find myself buying puts a lot, then basically, are you bearish on the stock? Do you want to just get out of that underlying stock or out of the portfolio that you've set up of stocks? Now, I didn't introduce the collar strategy in the examples, but I will introduce it using the options playbook, my website, to say that if you are worried about cost, if you're willing to give up some upside potential, you can sell a call to help pay for the underlying stock. Now, the whole concept is that you own 100 shares of stock, but now you're giving up opportunity costs. So you got to ask yourself, are you willing to sell the stock if it gets up to that strike? So that's the collar strategy, and then you can really reduce the cost of your insurance, even more so than just buying the put spread outright. All right, so now at this point in time, I'm going to exit the PowerPoint here, and I'm going to go in and look at a couple of strategies, and I'm going to highlight a few things here. Okay, so I'm going to stick with the S&P 500 index, but the title of this presentation is Hedging Your Portfolio. Okay, so that was the basics, and if you have any questions about that, we're not going to go, it's going to get harder from here on out. So we're going to get a little bit more advanced on this. Now, this is the options play platform. And you'll see here that I have the SPY in here. It's down about 0.5% on the day. And what we're going to look to do is buy some protection in the SPY. And the way that I look at this, if I have a portfolio of stocks, let's say I have a $100,000 portfolio, I could go in and buy a put on every one of the stocks that's in the portfolio. And a lot of stocks in a $100,000 portfolio would be, gosh, if you had 10 stocks, that would be a lot. If you had 5 stocks, and you can easily find the 5 stocks that track the S&P, or that are the biggest percentage in the S&P 500 index, and say that that is my portfolio of stocks. So let's work with the 5. Let's say we got 5 stocks, we have a $100,000 portfolio. If we go out and buy a put on all 5 of those stocks, and let's say we go out 30 days, or we want to get to the end of the year, okay? So let's go out 60 days. And maybe we just are worried about tax implications. There's a lot of reasons when you get to the end of the year why you might want to go out until the next year. So we're going to go out 60 days. And we're buying an individual put 60-day out on all 5 of the stocks that we have that are similar to the makeup of the SPX or the SPY. That's going to get real expensive. So is there a way that I could do it on a cheaper basis? And the answer is yes. If we buy an S&P 5 SPY option contract, the math is really simple. It's not going to be a perfect hedge or a more accurate hedge as buying the puts outright, but it is a way to do it on a cheaper basis. Okay, so how would I do the math? You literally take the price of the underlying 587.53, and you multiply that by 100. If you take 587.53, and I'm doing it on the calculator, I don't know why, and you multiply it by 100, you end up with $57,753. Now, the way that this is always thought of is that that is how much portfolio one SPY option contract would protect. So if you have a $100,000 portfolio, you would want to buy 2 put options to try to offset the risk of that portfolio. It's not going to track it perfectly, but this is one way to think about a cheaper way to insure your portfolio if you're nervous going into the end of the year. So we've recently hit some new highs, and all of a sudden the market started selling off. So with that said, when the SPX hit 6,000, which it did recently, this might have been a decent strategy to hedge your portfolio when that happens. And one way to do it is to look at the SPY. Now, you can do the same math with the QQQs, right? If you're heavy in the NASDAQ, you put in the QQQ and you look at buying some QQQ puts. Now, you can use the SPX, but the SPX is, the last quote that I got on the SPX is $5,877. So that is a big index, but you're talking about $587,000 of portfolio protection. So you'd want to consider the SPX if you had $1 million portfolio. So that's kind of the way that I would think about it if I'm looking at using the SPY options versus the SPX options. All right. Now, if I if I'm looking to do this trade though, that doesn't cover my deductible. I'm still thinking the exact same way as far as the deductible is concerned. So if I look at this trade that is set up in the options play platform, notice it still says it's bullish, but I'm saying if I have 100 shares of stock and I wanted to buy one put option, I still wouldn't look at buying the 587 strike, right? I'm still looking at buying the 580 strike overall. Now, if I just buy the put outright, that can protect my portfolio. And this goes out to the December 30th, 30 days away, December 20th. All right, we can make it 60 days. Let's go 60 days with it. Because I mentioned 60, so here we go. And if we look at a 60-day option contract, January 17th would be 58 days away. Now we're talking about $10 on our portfolio. So if I had a $58,000 portfolio and it somewhat tracked the S&P 500 index and the stocks that are in the S&P 500 index, I would be looking at a cost to insure this. Now, it's not going to be, once again, on a one-to-one basis. I'm going to buy a 7-point out of the money option contract, and I'm going to pay $10.21 for it. So 1021 times 100 would be 200 and, 10.21 times 100 would be $1,021 to insure about $58,000 worth of my portfolio. So if you want to know on a percentage basis, I'm going to take that and divide that by 58,666. So you're looking at about 1.7% of the cost of the portfolio. Now, if I do this trade, once again, and the market does come down, it's not going to go one for one with my portfolio, but I can also, once again, just sell it and close out my position and offset some of my losses inside my portfolio. Now, 1.7% is nothing to sneeze at. It's real money. We're going out 60 days, so we have a lot of time in this option contract if we're trying to get out to the new year. As I mentioned, I would err, and especially if I'm, well, let's put it this way. Let me start that over. If I'm buying a put option, I don't mind going a little bit longer with the intention of selling it because of the time decay. Now, if you buy it though and the market goes up, you still have that huge risk because you paid more for it, right? So you have more overall risk because you did a 58-day option contract versus a 30-day option contract as far as the put is concerned. The markets go down, you can sell it early, no worries whatsoever. So I'm going to lean towards a shorter term option contract, but if you want to do this and the market does go down, time decay is going to be your friend by going out a little bit further in time, and you'll have a slower rate of time decay on your option contract. All right. Now, the alternative is to come in and look at a long put spread. So in this instance, let's get rid of the security here. We're going to buy that 580. We're going to add a leg. We'll use that same expiration. And we'll go down to the, let's go down to the 560. We'll go 20 points. And then in this instance, we've cut our cost in 560, 560. Here we go. we've cut our cost in half, but we're only insured from 580 to 560. But that's a pretty big premium cut. Now, I'm going all the way out to the January 17th expiration, but if I'm doing this, this is here to offset my risk on my portfolio. And if I was doing an SPY as a portfolio hedge, I would look to do a bull put spread as opposed to buying the put outright, because I'm not looking for catastrophic insurance going all the way out until January at this point in time. So I would lean this way if I am looking at a portfolio response as far as my protection is concerned. Now, I have this call option in here. And if we go back, we got the put. Let's remove this leg. And there was our put to buy that outright. And if we own the underlying portfolio, this put would give us that protection. Now, one thing then, and this would be aggressive, but I want to show you something. If I add the stock here and we look at our protective put strategy, and I can pull this up right here, where we buy 100 shares of the SPY and we're going to buy one January 17th put option. We notice the profit and loss graph and the way that it looks: limited and known downside, unlimited upside. We can take the SPY and put it to somebody at 580 in this instance, and that caps our downside if we owned the SPY in this scenario. Now let's go back and let's look at a call option. And let's modify this. And we're talking about the 580 call option. Let's pull this up. Notice any difference? Right? This looks exactly like the protective put strategy that we just implemented in the SPY. So here's an aggressive way if you're nervous about the marketplace, and we've done this with a few of the daily plays after the election. Bullish but nervous, talked about buying some QQQs as an alternative to just buying NASDAQ stocks going out to January. But this is an alternative to buying the stocks in the first place. You sell the stocks and buy a long call, and then you're in that position. Now, in this scenario, I don't mind going out 4 or 5 months in time. I don't have all the capital requirement up to buy the stocks, but this is synthetically the exact same position. So in this scenario, instead of, let's say you were thinking about getting long the market, but you were bullish but nervous, why not think about just buying an in-the-money call option on something that tracks the sector that you would want to be in? The Russell 2000 index, if you wanted to get long small caps. For a while there, the thinking with small caps was that interest rates were coming down. Now they're a little bit nervous and the market's getting beat up again. Bullish but nervous on IWM, which is the Russell 2000 index. Why not, instead of having exposure buying the actual small caps or buying the index, why not consider just buying a call option on that position and going a little bit deeper in the money? So here, let me modify this trade, and we'll go out to the year end. If you see here, we had the run up in the IWM, and now we've had a pretty decent sized sell off in the underlying. Let's go a little bit in the money. We have the 229 strike here. So let's go down to let's look at something that gives us a decent amount of representation, has some decent time premium, or it has some decent intrinsic value. And we look at paying $13 as opposed to paying $229 for 100 shares of stock. So $1,300 versus $22,976 on the stock. It's a synthetic relationship. It's an interesting way to think about it. And this is not a bad way. If you had cash on the sidelines, you wanted to participate until we get to the new year and have some protection on the downside on your position. So I'd like to kind of show this. I'm going to run to my website, which is optionsplaybook.com. And here's the website, here's the homepage, and this is exactly what's inside the book, actually. If you have a long call position, you're just buying a call with strike A. You have unlimited upside and substantial downside. So ideally in this scenario, we're just talking about buying an at-the-money option contract. But if you look at this profit and loss graph, it's very straightforward. If I click on the protected put, where I own the stock and I buy a put at strike A, exact same profit and loss graph, right? Especially if you're doing the exact same strike. So synthetically, and let me scroll down here on the long call, okay. Synthetically, a long call is the same as a protected put. Now, the downside is with the protected put is that you got to own the stock, and sometimes it's relevant to buy the stock, but it costs more money to buy the stock. And because of that, sometimes a put will sell for a little bit less than the call. It's called put call parity, but I don't want to get into a pricing discussion right now. But this is exactly what I'm talking about. Ensuring if you have cash on the sideline, you want to participate, buy something that acts a little bit like the marketplace. You buy a little bit in the money, call option relative to the ETF that tracks the market, and you basically have a synthetic protected put on your position. Different way to hedge your portfolio, and once again, this is the way options were intended to be used, to give you protection on the marketplace. And then lastly, and if we have any other questions, you feel free to put them in, but lastly, here's the collar strategy. So on the collar strategy, all we're doing is we're combining the protected put, and then we're selling a call to pay for it. So by selling the call, we're giving up some opportunity, we're giving up some upside. And then on the downside here, we're buying some protection. We got that insurance, we have limited and known downside. But by doing this trade, we are, the biggest thing that is my concern here is that if you're doing it around an earnings report or you're doing it around a big news event, you're not doing it just because you're nervous about what might happen to the markets in general, is that you could get pegged on this, right? If the market gapped open, you wouldn't be able to participate in any upside above and beyond that. But a lot of times they call them a zero cost collar. You go about equidistant in and out of the money. You sell an out of the money call, buy a little bit in the money put, or just you buy an out of the money put and you sell an out of the money call, same distance away. A lot of times you can get that done for zero to your account, and your insurance doesn't cost you anything. And there's no additional margin requirement because you own the stock. So you own the stock, you sell a call at strike B, and that pays for the put at strike A in that instance. All right, so I did promise you that we would look in NVIDIA, and we would talk a little bit about a trade that you might do in NVIDIA to try to protect your portfolio against a downward movement in the marketplace. So if I'm buying options outright, NVDA, they're going to be expensive, and I'm not going to go out far in time because of that. The stock right now is at 145.24, but if you scroll back on the charts, you see that it's had a pretty good month, right? From all the way down to 99 to 144 over since September on the stock. So pretty much straight up, a little bit of a pullback right here, which you could consider might have been a buying opportunity. But bottom line is if you own some NVIDIA stock, unless you bought it just recently, you probably have a profit on it. Bullish but nervous. Once again, where do I think NVIDIA is going next? I don't know, but the earnings report is a nervous scenario that can happen with this stock without a doubt, because you've had a good, it might be the buy the rumor, sell the news, see it sell off a little bit, but ultimately in the long haul, probably bullish on NVIDIA just in general. So what are two trades that we could do? Well, this is an instance where I would definitely want to look at a long put vertical spread or a bear put spread as a hedge against my 100 shares of NVIDIA. So if I'm going to buy a put outright, let's start with that. Let's go in and get bearish here. And we'll modify, let's modify this one. And this is a put. Underlying stock is at 145. Let's go a little bit out of the money and see if we can get some, save us a little bit of cost. Let's look at the 140 here. $8. All right, so if we take $7, 140 is $5, okay, and then we got $8 worth of premium. Our total risk, oh, that's way too far out. Let's go 9 days. Okay, $4.50. That's way more affordable. But if we're at 140 and you want to buy this put, that means you're going to take the first 5 points of risk. So 5 divided by 145 is 3.4%. So if I bought the 140 on my 100 shares of stock, I would have 3.4% of risk before my insurance kicks in. That would be my deductible, i.e. that would be 5 points. Now, it's trading for $4.50, so the math gets really easy here. If you buy this option contract for the next 9 days, and basically the premium is as much as the deductible, you're looking at about 7% of your max risk on NVIDIA going into the earnings report over the next 9 days. So if you're nervous and you think you might want to get out if NVIDIA does go down more than 7% on this underlying stock, this would be the put that I would probably consider buying. I'm only nervous about the earnings event. I don't need to pay the premium going all the way out to January, which was where we defaulted at. This is where I would go if I was buying protection and I wanted the unlimited or the catastrophic protection on NVIDIA. So if the stock went all the way down to 100 after earnings, and it's not, I don't think that would happen, but it's not unfathomable that it could happen. You could take the stock at 100 and put it to somebody at 140. That's what this protection would do. Now the alternative, and this would probably be the way that I would lean, is let's go in and look at this. We have the put options, put that at the midpoint. Let's go back down to 9 days. And in this instance, we'll buy the 140, but we can even with NVIDIA, you can, especially around earnings, you can go way out of the money and give yourself a good bit of protection. So let's look at even from 140, let's go down to like 135. And we see that the 135 strike put is still trading for $2.77. So you're still taking a big chunk out of that premium to buy that 140 strike. So that would give the 135, that would give you 5 points on the downside. If we go more down towards the let's go 125. We can still get $1 for that trade. You're still talking about 20% of the premium that you're taking away by selling the 125. So maybe you go to the 130. 130 is trading for 164. 164. So now my insurance has gone down to almost $3 in this instance, a little bit less than that to insure that position. So ideally, if I was doing this, I think I'd go down to the 125 because we can still get $1 for that. And then we got 15 points of downside. Now you're talking about real protection. I'm not as nervous about NVIDIA blowing away all the way down to the 100 level, to use our first example. But this would be the way that I would approach this if I was looking to insure NVIDIA going into their earnings report tonight on the close. This is the way that I would lean. 9 days out, buying the 140 strike, 5 points down, 3.7% down deductible, paying $3 and well, we'll just round it off here. So $3.50 for a long put spread that would protect my stock. That simple. All right, I'm ready for any questions that you may have, and I'll keep this platform up Well, actually, let me go and put my information out here. So I'm Brian Overby. I'm the Senior Options Strategist at Options Play. If you'd like to check out the Options Play website, you can always go to optionsplay.com. Follow me on X. My handle is at Brian Overby on X. And my book website we highlighted today is optionsplaybook.com. I must have did a fairly good job of explaining the questions because right now I don't see any questions. And then I'll give it a few more minutes. And I'll leave this trade up, our long put spread, as the protective trade on NVIDIA. All right, Jeff, I appreciate it. Yes, everyone, I hope you enjoyed this. We will make the slides available for you, and then we will also send out the recording. You will have access to this recording too. So thanks for coming, everyone. I see that we've answered any questions that we may have, and we will see you shortly for the next education for first trade clients. Thanks for stopping in.